Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today, Dan interviews our colleague, Greg Diamond, editor of our 10-Stock Trader newsletter.
And today, Corey and I will talk about inflation, the European Central Bank, bullishness, bearishness, oh my.
And remember, if you want to ask us a question or tell us what's on your mind, email us at feedback@investorhour.com.
That and more right now on the Stansberry Investor Hour. Bullishness, bearishness, oh my, oh my. Well, maybe let's talk about inflation first, because I think, that just dropped, a couple of days ago, and people are sort of wondering about it. I mean, do you even care at this point? The market doesn't.
I do and I don't. When these numbers came out, the CPI numbers, and then we had some more commentary from the European Central Bank, both basically talking about higher energy prices, which have been happening for the last month or two, haven't shown up in this backward-looking data yet. So kind of been expecting it. I do and I don't, because then I just keep thinking back to like the real super big trend of the pace of inflation coming down really still hasn't changed yet. I mean, yes, this was a higher like month over month outcome for this like CPI data based on energy, oil prices going up. Overall, it's still declining, but I think it does tell you just like, okay, before 2021, nobody was really, or who was really paying attention to monthly CPI data? Not a lot of people, other than it was what it was, and we have no inflation, And now these variations, people are paying attention to them a lot. So I would just stick to paying attention to the trend, which could change, but for now, I don't think it has yet.
Okay, so, and by paying attention to the trend, you're talking about the trend in CPI, the trend in...
Right, so the monthly... the month over month changes, because I can't pay attention to the year over year headline stuff anymore because of just the base effects year over year. It gets way out of whack very quickly.
Explain that for our listeners. Explain that.
Sure. Yeah. So CPI, the headline number that you'll see in headlines, is year over year. It's a year over year comparison. So it's an annual comparison based on the same month the year before. So it could be 3.5%, whatever, 4%. It was 9% at its peak, right? That was the difference. But at this point in the inflation story, I think the more important thing to look at is the monthly change in inflation, which will tell you if the pace of inflation is actually accelerating or decelerating. I think the previous 2 months before this one is like 0.2%, which is historically pretty normal, As far as, of course, we would love no inflation. Some people would love no inflation in terms of devaluing currency and that sort of thing. But from a steady growth perspective, at the same time, it's been like 0.1, 0.2%, that sort of range in the last several decades, and definitely that low inflation era of before 2020. So that's kind of the number I think is important to pay attention to if you're worried about whether inflation is going to rebound totally or not.
Right. And this August was 0.6%. So big difference.
Right.
Yeah.
Big difference with the energy prices. And so I actually kind of see why the Fed, strips out food and energy prices to a certain extent when they're looking at this core number, which we've talked about before. Of course, food and energy prices matter to a heck of a lot of people, though. So it doesn't really reflect reality, but it's what they do. Neither does monetary policy. So that's kind of makes sense to that.
Yeah. Name an industry that doesn't spend more when oil prices go up. It's not easy. It's not easy. And, food prices, oil prices, I mean, those are the core of everyone's life. And I understand the focus on the data and, looking at the headline number go from 9 to 3 or 4 or whatever and feeling good about it. But, people are just paying more for stuff and real household income is down, so it's
right. And I think, a lot of market commentators and stuff are just kind of brushing off the fact that, we can be stuck with 3% inflation. Like that'll be okay compared to 2%.
I know.
Like, we're not talking huge numbers here. The scale of that is, going from 2 to 3 is pretty significant over time, if you're just going to accept that as reality.
Sounds like a 50% increase to me, which is a lot in the rate of change of prices. Whoa.
Yeah. Like, I know these are little numbers. I know we're not over 10. We're not talking about, big numbers on the surface, but in the scale of it is pretty big. And we're not even below 4 yet. Like in the PC, the number that actually matters to the central bankers. So
yeah,
it's
speaking of central bankers.
Yeah,
the central bankers in Europe have done a thing. They did a thing recently. They raised interest rates to an all-time high because their consumer prices are, in their opinion, so out of control. And there's double-digit inflation over there. It's a different picture in some places. So the ECB lifted its deposit rate for the 10th consecutive time by 25 basis points to 4%, which doesn't sound like an all-time high of anything. But when you've been negative in the past and 4% is a lot. 4% is like very normal, but that's another thing about what's going on right now. 5.25% or whatever it is, right? At the top in the United States, and 4% over. Like, these are normal rates. This is normal. And everybody's complaining, oh, it's too high. No. It was way, 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 way the hell too low. It's difficult to appreciate that, I think, for most people.
Yeah. I mean, low rates, right? We don't say this enough, or I don't say it enough. Like, low rates benefit who? The the people who have capital and are already okay, right?
Mhm.
Higher rates, nobody really in the market likes that, right? Like, nobody wants essentially higher interest rates if you're interested at all in stocks.
Right.
So that's why I try to keep remembering this when I hear people on TV and radio, like, fretting over the next 25 basis point hike or something.
Yeah.
Like, of course, that's why you don't want higher rates. But at the same time, the inflation piece of this is killing just people on Main Street, racking up this credit card debt. And, it's over $1 trillion, in the US. There's a record amount of credit cards.
Mhm.
Real income isn't keeping up with real GDP.
Yeah.
And yet stocks are going up on balance for the last year or so. So it just shows you again that dichotomy in the market and the real economy.
Yeah.
I don't know how it ends, but I think ends up with everyday people for now getting short end of the stick, I would say.
Yeah, as always, right? As always. Right, there's one thing we can count on, it's, the man sticking it to the little guy. It sounds cliche, but it's just too true. It's way too true. And certainly, like, higher oil prices, people who own lots of oil stocks are doing great, but, people who have to pay, for whom putting a tank of gas in their car is really a big deal, they pay, and they have less. As we've seen in the, certainly the Census Bureau data, what they call real median household income peaked in 2019 at around 78,000 and now is below 75,000. It actually, like, when I was a kid, that was a lot of money. That was like, if you made, I remember being like a preteen or teenager or something, and my father was talking to my mother. He didn't know I was right there, and he said, I made $25,000 last year, and he was kind of bragging a little bit. I mean, he had 5 kids at home and it was fine. And my mother didn't work at that time. So, yeah.
And now we have, obviously that 25,000 doesn't do what it did then. And I also read over the past week, the amount of people in the government's level of poverty is the largest rise on record in over 50 years recently. Like, it goes back to the stimulus efforts of the pandemic, and specifically like the child tax credits, which so many people were getting. Now they're not. And now prices are higher, but incomes are not. So what do you do? It's, I don't know. It's not good. I think this will all come to a head somehow the political cycle ahead.
Yeah. And,
as what it means for the market's going to be debated. Yeah.
That's right. History kind of lays it out. And Eventually,
Yeah.
there is too much pressure to spend more and borrow more, and essentially when the government borrows more, they print more, they issue lots of bonds, and if you listen to Ray Dalio, he says we're getting to the point where people don't want to buy the bonds. It makes you wonder, like all this backdrop of macro that we're discussing, makes you wonder where all the bullishness comes from. I mean, did it just get too overdone last October, and the Nasdaq bottomed in December, I think it was, and yet here we are, like the market's not too terribly far from making new highs, like all-time highs. Um, I don't know. I have to say, anybody can look at a chart and say, well, market's been going up for months and months and months. Bottom last October, November, December, whatever. And so I understand it, right? I understand that basic idea. People are buying, you want to buy too. But I don't know. All this other stuff that we talk about, it seems like that ought to figure in, like bond yields just going up and up and up and up. There's a number of ways that affects the stock market. And I guess people are just so convinced that we're near the top in bond yields or something, and they're going to start cutting rates soon or something. I just it all looks precarious. The bullishness looks precarious to me, but all bears say that, don't they?
I believe they do. That's why it's bulls versus bears.
Yeah.
And it's not. You look at the last couple months. It's really not the market. S&P 500 is not that much higher since June.
Mhm.
It took a bit of a swoon in August, so it's not like a rip roaring bull market, but it is. Yeah, it's the trends are up. As I'm sure Greg Diamond will talk about and in his analysis, and so yeah, if you're looking at it from a price perspective, you look at the charts. That is what it is. I'm not going to ignore that, but I'm also not going to ignore like reality for people when we're talking about the economy and problems that inevitably will do something to the stock market. And when they do, it's generally pretty big. when the Main Street problems get to the point where people on Wall Street start freaking out, that's when those are the crises that they say happen, and then we get into all the rescue measures, and the cycle goes on and on. So I think you can be bullish like on stocks and still recognize these risks at the same time, and just if you're in the market at all, you should always be paying attention to that and thinking of that. It's not a risk-free environment.
Right. Which is not to say it's been easy to make money this year in stocks. I saw something from Mike Green of Simplify Asset Management, who I'd love to have on the show, Mike, if you're out there. And he posted a chart of the Russell 2000 equal weight index, right? So equally weighted 2,000 companies, 2,000 of the 3,000 largest. And he said, hey, just a quick reminder here, most stocks are down for the year because the equal weight Russell 2000 is about flat. It's like minus zero point 0.4 for the year. So, or maybe minus 1.6. I'm not sure which chart to look at here. But anyway, it's down for the year, flat to down. That's interesting to me. And I recently wrote in the digest about the phenomenon of so-called passive investing, which is not passive at all. And I think in large part we have that to thank. People just keep putting money into their 401ks, and most of that money goes into the biggest stocks. So all the stocks that support the S&P 500 and the Nasdaq, they get all the money. And like I think the top 10 market cap of those indexes gets like a third, close to a third, more than a quarter of all the money that you put into your to them, which is really interesting when you think about it. And so all these smaller companies, they're kind of sucking wind compared to the big daddies. I'll tell you what, when those big indexes crack, that tells you something. It tells you something that people even sold those stocks last year, that they sold the big stocks enough to push the S&P 500 down 25%, Nasdaq down 36 at the bottom there in December. That's when people are scared, when they're selling whatever they can sell to raise cash.
Yep, any and everything to cover their losses.
Yeah, to stop the bleeding. Yeah. My fear is that the thing that supports those indexes will reverse, right? The algorithm is simple. They get $1 of capital, they buy $1 of equity, 30 cents goes into the top 10 stocks, whatever, and it just goes on and on and on. And my fear is that, people will get scared enough. And I saw an article, I didn't quite grasp, it seemed a little non-specific, but it was talking about the number of loans, the amount of loans against 401ks, because you can borrow against your 401k, ticking upward, and the amount of what they call, I forget the name for it. It's like distress. You can declare distress and take money out of your 401k, and that stuff is ticking up as well. So it makes sense. You see the credit card defaults and the auto loan defaults, and then you see these loans and distress withdrawals ticking up. It makes sense. And banks performing poorly also makes sense. And it's all a bit troubling, but as a trader like Greg Guyman might say, you got to stick with the trend, right?
Yeah, no, there's definitely risks out there, but the some people and traders and technical traders in particular, all they care about is the charts, right? They don't care about like anything we just said.
Right.
They just care, what is this price doing and how do I make money or not lose money? And there you go. And there's a lot to be said for that strategy. And if you can do it like Greg, more power to you, because he's great at it.
Right. So on that note, let's check in with him. Let's talk with our friend and colleague here at Stansberry, Greg Diamond, one of the best traders we know. Let's talk with him. Let's do it right now. Do you own any of America's 7 most dangerous stocks? These 7 stocks have been on a tear this year, driving about 75% of all the gains the S&P 500 has seen in the first half of 2023 and leaving the other 493 in the dust. But here's what most folks don't know. Owning even one of these 7 could be a dangerous mistake. That's because what's around the corner for the stock market could catch you off guard. It's a distinct pattern that happens roughly every 10 to 12 years. And each time it opens a rare window in the stock market where investors stand to create or lose huge amounts of wealth. Right now, it's on the verge of happening again. We put everything you need to know, including the names of those 7 stocks, in a new report that we'd like to send you today for free. Get the facts yourself. Go to www.stockstoavoid.com to get your free copy of this report. You can get the full list of the 7 most dangerous stocks and prepare for what's coming. Again, that's www.stockstoavoid.com for a free copy of our new report. Greg, welcome back to the show. Good to talk with you again.
Likewise, great to be here.
So I am looking at some notes here that I made, and I noticed that lots of Stansberry editors are bullish, and we just had 2 of them on the show. We had Brett Eversole and we had Matt McCall together, and they teamed up on me and went all bullish on me, which, I survived. I was okay. So I know one of the great things about Stansberry is, of course, we all come at the market from a different perspective. And I wanted to get your sort of overall take, if you have one even, if maybe you're neutral, I don't know, as to where you think things are going right now.
So I think, as you know, I kind of look at the market different than most of our colleagues in the fact that, I'm technically based, but it's based on price and time. And with that said, I will switch if the market tells me to switch. 2022, I was very bearish. I traded from the bearish side pretty much all year. It was very successful doing that. Then, called the bottom in October. And, the first 3 months of this year were a little choppy. We had the banking crisis, this, that, and the other thing, but have been largely bullish since. Just take today. So it's yesterday and today. So the inflation number, CPI was higher and PPI was higher, and the market's rallying. So again, from price and time, and over the last few weeks, I said, look, if based on inflation and or the Federal Reserve, future monetary policy, whatever it might be, if that dictates based on time and price, meaning the trend's going to break down and we see this inflection point, I have no problem switching bullish to bearish, but we're not seeing that. So if you would think that inflation is rising, or expectations are higher than what the market might think, and the market still rallies, that tells me that there's too much fear, there's too much short positioning, and we'll probably see another rally. So that's kind of where my mindset is. I reduced a little bit of risk over the last couple of weeks, but I'm still bullish.
Okay, so reducing a little bit of risk, but still bullish. All right.
Yeah.
Are you? I should know this. Forgive me for not knowing. Do you trade like sectors or mostly sectors, mostly individual stocks, indexes? What do you really focus on the most?
All of the above. So my service 10 stock traders based upon the fact that, I rarely hold more than 10 positions at any one time. You always hear about diversification. You always hear about, don't put all your eggs in one basket. I kind of take the opposite approach. I put all my eggs in one basket and I watch them very, very closely.
Okay.
So, I tend to trade the same stocks, the same sectors, the same indices all the time. So that's kind of, again, I narrow my focus and I kind of trade what I like, for lack of a better explanation. And, I stick with it and it's worked.
All right. Let's see. I know you don't want to give away any picks or anything because they're for your subscribers, but is there, for example, like I noticed most stocks are down. So if it was possible to trade like, the Russell 2000 equal weight or something, I don't know. Maybe you would be bearish, maybe not. But is there a particular like sector or I don't know. Is there anything you could tell our listeners? Because they put it this way, like they love picks, right? They would love you to, give them a stock that you're bullish on or bearish on, or a sector or anything. So how far can you let us in?
All right. You know what I'll do? I'll give you a little bit of bearishness, to kind of pique your interest.
Mm-hmm.
Okay. And then a little bit of bullishness as well. And what I mean is, so everyone's talking about AI and semiconductors. I get it. It's, ad nauseum. You just can't, you get on Twitter, you watch the news, whatever. It's all over the place. Okay.
Mm-hmm.
That trend is going to run until it doesn't. However, when you see one sector largely outperform another sector, that's called price divergence. And we're seeing this in a large capacity. If you look at semiconductors relative to banks, the spread is incredibly wide. And you mentioned Russell 2000 small caps. A lot of the regional banks are in the small cap sector.
Yep.
Also, just wildly underperforming. So heading into next year, that's going to be a problem. And I'll give away a little bit of a secret. I think that 2024 is going to be a trader's market. So what I mean by that is I don't think we're going to see these large, huge uptrends continue. I think it's going to be a little bit of a pause. I think it's going to be a little bit, especially heading into the election, which, I won't get into because I have no idea what's going to happen. It's going to be a little crazy, but it's going to, so that spread, that price divergence that I talked about, small caps, banks, and then AI, semiconductors, is going to be a problem. And there isn't a healthy economy or a healthy stock market for that matter when the banks are underperforming. Why is that? Well, the banks provide all of the liquidity for everything, for all businesses, whatever. You want to blame mortgage rates, fine. You want to blame inflation, I get it. You want to blame Federal Reserve, I get that too. The why doesn't really matter. My point is that history has shown when banks are underperforming, there's a problem. So that's kind of something, again, from a bearish perspective. However, on the bullish perspective, I do think this trend rallies into the end of the year. We're in a seasonal point where everyone talks about September. I get that. However, the uptrend is still there. And, the old saying is stay with the trend until it ends. The trend is your friend until it ends, whatever it might be, whatever particular phrase you want to use. So unless that breaks, I'm not fading it. So, watch out for the price divergence heading into 2024. But right now I'm still bullish as long as the trend holds. That simple.
Okay. That's simple. And a lot of people like to obsess, like you said, a lot of people obsessing about AI right now. A lot of people like to obsess about the Fed too. I mean, obsessive. Like, it's funny because folks weren't obsessed when interest rates were zero. They were partying. And now every tick higher is like, oh, they're going to kill the market. Oh, this is bad. Or some people, oh, this is good. They're not far enough, too far, whatever. I feel like, it's like Jim Grant says, it's like we're watching a baseball game and everybody's talking about the umpire rather than the players. Do you care at all about the Fed?
Yeah, I do. I like that analogy, the Jim Grant. I'll make another one. People say that the Federal Reserve is independent and not political. It's a bunch of BS. It's just so ridiculous. Okay, they're nominated by the president, and then they're confirmed by the Senate and the House. You don't get any more political than that. It's just ridiculous to think that they're independent. And the banks all have a share, and then the bank, whatever. It's just absurd. Yep. And then the Federal Reserve has two goals of, inflation and unemployment. Now, the Fed's goal is to make sure that the stock market doesn't crash. Let's be honest. Okay. So that's their main goal. Okay. Is to make sure that all the rich people that they, serve, for lack of a better word, are happy. Right. I mean, and they fail miserably at it we saw it in 2020. And what they did to try to bail out this stuff was print more money than has ever been printed in the history of civilization. Mm-hmm. And now we are where we are. I mean, we saw that last year with 2022 and inflation. And, regardless of what the numbers actually are, people are feeling it wherever they go. Inflation's ridiculous. It's out of control. But at the same time, so, that's the pessimistic side. The optimistic side is that the stock market discounts what's going to happen in the future based on what's happening now. So, a lot of people, I don't understand the stock market. It doesn't make any sense. Inflation's doing this. I know, because they're inflation, CPI, official numbers, not what you see at the grocery store, but the official numbers are, went from 9% down to 3 or 3.7, whatever. So if you were a hindsight trader or hindsight 2020, and if you could go back in time and said, hey, the inflation went from 9% to 3.5%, what would you do with stocks? You would buy them. And that's what we saw in October of last year, right? So I do care about the Fed because they do pull the levers. But, I think we're kind of in this situation now where they're on hold, or maybe they do 25 just to, make sure that they don't screw up as much as they could, even though they probably will again. And I think, again, I mentioned today that, yesterday was CPI was higher. Today, PPI was higher, and the market's still rallying. So to me, that tells me people are too fearful. They don't have as much exposure to stocks. They're, if not outright short. And if the inflation number's higher and stocks still rally, that tells me the pain trade's higher.
All right. Pain trade is another way of talking about the wall of worry, just for the listener's sake.
Correct.
Meaning that stocks tend to climb a wall of worry rather than fall, like many would expect. So I want to switch to a little current pet peeve of mine, which is the bond market. If you look at, I'm not a technical guy, Greg, but I can look at a chart for 2 or 3 years and see whether it's gone up or down in, 6 months and stuff. So I get bullishness right now based on technical factors. I think I do. I look at the charts, I say, wow, S&P 500 and NASDAQ, they're coming up on a year off the bottom here. So, I get it. I get it all day long. And when I take the 10-year, the CBOE 10-year yield index and flip it upside down and do a 2 or 3 year chart, it's just a bear market, period. That's all it is. It's not something that, bottomed out it's just a bear market still. And I'm like, okay, let's see here. The bottom was like 821, August 21st, very recently, I think. So when I look at just the overall idea to me is like, if bonds are suffering, like stocks can't be far behind, because like in my mind, bonds are senior to stocks, right? In the capital structure of a company, we all know the bondholder gets paid first, then the stockholder, and the stockholder gets paid last, not just after the bondholder, but dead last. And we think of equity I think of equity the way a credit analyst does, right? It's the first layer that absorbs losses. But equities don't seem, sure, most of the Russell 2000 is down about 2% year to date, but being bullish has been the way to go this year. So nobody's nobody's looking at that layer and thinking, "Oh, they're going to take some hits here soon." But when I look at the bond market, I think, equities earnings have to grow 10 or 12% the next 2 years to justify, the current situation. And then when I look at the bond market, I'm like, the alternative, like the farther down the price goes, the farther up the yield goes, and the alternatives are getting better and better to equities. Like, I can throw a couple $1,000,000 at treasuries right now and have a nice income, have a six-figure income. So does the bond market worry you, is what I should have just started out by saying.
Yeah, I mean, so I'll say that the days of 0% interest rates, even 2%, inflation, that's gone. I mean, it's over. So you want I mentioned that the Federal Reserve printed as much more money than any time in human history, right? And I think that as a result, that was the low in interest rates and inflation for over a 5,000 year period or 2,000 year period, whatever time period you want to look at. We're not going back to that. That's a generational low. That's probably the best way to put it. So, you want to get a 2% mortgage, good luck, right? You're never going to see that again. I remember my parents telling me, that they bought their first house and their mortgage rate was 15%. We're headed there. We're already there. It's 7% now. So, the days of, low interest rates and, you can buy a car and, finance it for 8 years on, but it's game over. That's game over. However, that fear, especially relative to the stock market, is why we saw this push. And you have to factor in artificial intelligence, because a new technology, kind of like the internet in 1995, it can last longer than you think. So, and I kind of mentioned the spread between, banks, small caps, and these semiconductor technology stocks. That spread, along with what you're talking about in the bond market, is going to be a problem, especially into next year. I mentioned it's going to be a trader's market. I'm actually looking forward to that. So, yeah, the bond market does worry me, because it's not, the Fed can't cut. I just love how people are like, oh, they're going to start cutting. They're not going to cut rates. They can't afford to do it. They can't. They can pause, sure, but they're not cutting rates. It's just not going to happen, because they can't risk what happened in 2022. They just can't do it. So the bond market does, I don't know, worry is the right word, but it's, in terms of the way that I look at the market, in terms of price divergence, in terms of interest rates, it's a factor that says, okay, how low can bonds go? How high can yields go? And we saw it over the last month, yields started ticking back up, and then we saw stocks kind of go sideways. So what's the level of, whether it's a 2-year, 10-year, 30-year, whatever you're looking at, what's the level where stocks react negatively? We kind of saw that, so it's kind of hard to, predict what that level is, but we see when it rallies too much, when yields rise too much, stocks don't like it. So it's definitely a factor that you need to be careful of. But to your point, what's the risk-free rate of return right now? It's pretty good. So, throw some money at the bond market and you're going to be okay.
Yeah, I mean, and just to be clear, like when I say throw it at the bond market, I'm talking about treasuries. But there are probably some really great corporates out there too. I mean, there's plenty of investment grade corporate debt out there of companies like Apple and whoever. They're not going to default ever, so you're going to get paid.
Right.
And yet, they respond to all the same cues as treasuries and everything else. So the yields improve there as well. So I see. So I guess in general where I'm headed here is like when I'm asking about the Fed and the bond market and things, these things sort of are on your mind, but your trading is entirely about price and time. So even if you look at the bond market and say, my God, if yields tick up one more bip, this thing is going to collapse. You don't do that. If price and time tell you to be bullish, your ideas about the Fed and bonds and the economy and anything else, like you complained about inflation a moment ago, you said it's terrible. No matter what the numbers are, people are feeling it. And we could talk about things like, bankruptcies ticking up and car loan defaults and credit card defaults. All those things are at the highs since the financial crisis, right? But you don't look at those and say, "Oh, I better get cautious here." It's just price and time. I find that to be like just an incredible exercise of discipline. Do you have trouble? Do you look at your trades and go, "I better get off of this because I know it's going to collapse"?
No. So I don't know if you're, I'm in my office basement or basement office rather, and I never turn on television. It's not that I don't see the news or hear the news or see it. I just, the older I've got, or the older I get, and the more that I just keep doing this, the less noise that I have, the better I do. So again, time and price is my discipline, and that's what I've learned over a period of almost 20 years now. And that's how my mind works. That's what has led me to be somewhat successful, and I'm sticking with it. So, here's the thing though, it's always something to worry about. Always. There's always going to be that wall of worry. There's always going to be, well, this is happening. Well, this is happening. Yeah, I get that. But at the end of the day, we are what our record says we are. And my job is to make money, no matter the market environment. Bull market, bear market, my job is to make money. So I can sit here and list off 10 different things that could go wrong. Okay. But at the end of the day, it's really about the market behavior of all investors all over the world and what they're doing at this moment in time. Are they too fearful? Are they too greedy? Okay. And that is reflected in price. That's what technical analysis is. It's a collective behavior of everyone in the room expressing their behavior through buying and selling. And when those reach extremes, that's when the most money is made. So, you want to talk about inflation, you want to talk about the bond market, you want to talk about the Federal Reserve, you want to talk about bankruptcies, you want to talk, I get it. All reasonable, fundamental catalysts that could lead to something. But right now, it's simple. The trend is up. I'm not fading it. I can't. And especially when you see, I mentioned it a couple times earlier, and I'm going to mention it again, when the catalyst for 2022 was inflation. And when inflation was rising, stocks were crashing for the most part. Now we're seeing it, it dropped from 9% to 3.5%. Now it's ticking up a little bit, and yet stocks are still rallying. Why is that? It's too fearful. Okay. And then you revert back to, guess what? Time and price. The trend is still up. It's not time to sell yet. So I'm bullish.
All right. There's no shaking your resolve when time and price are on your side.
Can't do it.
Yeah. I always ask a question like that. I don't mean to doubt you or anything, but I asked a question like that because of an episode that I've mentioned before. Steve Sugarwood and I visited one of the turtle traders many years ago. This is 20.
Richard Dennis.
Yeah. And, of course, they're the people who practically invented, the idea that you just pay attention to price and time. And, back then, those were the old days of trading like 21-day breakouts or something like that. And so we were on the trading floor, and we were with the head trader. We were being walked around by this vice president guy, and he said, "I'm going to leave you with the head trader here for a little bit." And I'll never forget this, Greg. There's a whole floor of PhDs underneath us, math PhDs working on this system to spit out these signals. And there's these traders upstairs where Steve and I were, and they're saying, if you don't trade the signal, you're fired. And the head trader looks at a chart where actually he drew it. He was talking hypothetically, and he drew a little 5-day pattern. He said, we're trading cable right now, the British pound. And he drew a little 5-day downtrend. And he said, yeah, we trade the signals, but do you really want to short cable after 5 days of that? And I was like, we didn't say anything, but I will never forget it. I was like, I wanted to say, are you telling me that you're not trading the signal? So, yeah, that's right. But clearly, the guy was not fired. So I don't know. That's why I always ask all the traders who talk about their discipline and price and time, don't you don't you just change things a little bit now? And all the best ones said, no, Dan, no, 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 you can't shake my faith. It's discipline. You stick to it. And I think that to me, that's like the big lesson of, or one of the very big lessons of what people like you do. Were you always that way? Did you always find it easy to have discipline as a technical trader?
Yeah, I know it takes, everyone thinks like, I don't know, like you like come out of the womb and you just like, hey, I'm gonna go buy a Porsche and drink some champagne. It's like trading is this like easy thing. No, there was a lot of pain, there was a lot of failure, and that failure and that pain led to the discipline. It led to risk management. It led to the strategies that I use. It's not, it's learned. Yeah, I mean, are there certain qualities and characteristics that you're born with that could make you a good or better trader than some? Yeah, maybe. But I've never met a really good trader that did not fail, because it leads you to the discipline that you have to be good. I never met someone who just like, oh, right out of the gate, I was just making millions and then, it was all good forever. No, because the markets change, you have to change your, how you look at it. You have to, you're always going to have that discipline of risk management and understanding that losing is part of the game. But you have to have some type of roadblock that changes you to get into the role that you have of understanding what your strategy is and then maintaining that discipline. So no, it's not always, if it was easy, I mean, I have a fleet of jets and be on my own island, but I don't. And a lot of people don't, I drive a Suburban and I cruise around on my John Deere tractor cutting grass. And, I don't have a fleet of jets, but I'm happy where I'm at. I love this company and, and helping individual investors. This is, I found a home here. I'm going to be here as long as they don't fire me. I don't get hit by a bus. This is where I'm going to be. But I like telling people or teaching people rather, look, this is what it takes to be a successful trader. This is the discipline. This is the risk management. This is my strategy. Follow me, hopefully you learn something, if I'm not your, cup of tea, that's okay too. Like I said, I'm different than most of our colleagues. I'm different than most editors, but I trade every market, bull market, bear market. My job is to make money and showing people how to do that. And that takes discipline. It does.
Right. So, I'm glad you once again mentioned the differences between yourself and others. Like over the past, at least 15 or so years, all I've been hearing within Stansberry, the overwhelming chorus, when you ever mention trading options, the overwhelming chorus is selling, selling puts, selling calls, et cetera, et cetera, et cetera. And the idea of this being like an insurance policy, right? And do you want to be in the business of buying insurance or selling it?
Right.
You're not one of those folks, though, are you? You're a trader. You're a pure trader.
Yeah. So I'm directional. So, think about, let's put it really simple. Okay. Is the market going to go up or is it going to go down? I don't care what market you're going to talk about. Okay. Is it going to go up or going to go down? As a trader, pure trader, as you said, my job is to figure that out. Is the market going to go up or is it going to go down? There's no guarantees. I put together probabilities based on time and price of what's going to happen. And I use long options, which you said, not a lot of people do, as leverage. And the smart thing is to sell options because the way that they're formulated or calculated or, just the nature of options is that they decay over time. And by selling them, you take in the premium, and over time, they decay to zero and keep your premium. Totally understand it. It's less risk. I take the opposite side and use as much risk as possible, but I use position sizes and time to use that leverage to my advantage. So if I didn't understand the concept of time, buying long options, I wouldn't be very successful. But because I use time analysis, time cycles, I can use that to my advantage to buy options. So that's kind of what differentiates me. But I also, every trade that I make, I have a position size recommendation. My position size recommendation is my stop loss. And what I talk about it over and over and over again in my newsletter is, losing is part of this game. Show me a trader who's never lost, and I'll show you a liar. So understanding that and having that mindset means, okay, I'm going to have this position size because I will be wrong. It's going to happen. It happens every year. It's fine. But as long as I'm right more than I'm wrong, we're going to win in the end. So, that's kind of my, mindset around trading options, long options.
Right. So just in simplest terms, last year, I know you did really well. And you said you were trading, bearishly. So you would have been buying put options. And this year, if you're bullish, you're buying call options, just in simplest terms. Okay.
Yep.
All right. I'm glad you said that. I personally don't sell options either. I only buy them, and I buy teeny weeny tiny little amounts of them, mostly as a kind of an insurance policy. But we won't talk about me because I don't know what I'm doing, and you actually do. So, so I find it very, very interesting. Of course, we always wind up here whenever I talk with traders, and I've talked with like market wizards. I mean, we've had trader after trader on this program, market wizards, all kinds of folks. And, traders who were covered in Jack Schwager's Market Wizards books, and Schwager himself, and you and all kinds of other traders. And we always wind up at the same place. We always wind up talking about, you just mentioned position sizing, and risk controls. And I'm actually currently writing a piece that by the time we get this podcast out, it'll be published in the digest, the Stansberry Daily Digest that all our paying subscribers get. And, I couldn't help discussing it there. It's just incredible. Like, people don't pay you for your ability to predict things. They pay you for your ability to have the discipline to exploit those trends, right? Because if you don't have the discipline, you're going to get killed, right?
I mean, yeah. I love that.
And it's got to be difficult. Look, you and I, we know human nature. You just talked about it a minute ago. You don't come out of the womb doing this, right? And people fail, and losing money is a part of it. Like I said, we had market wizards on. Some of these guys are like, yeah, I'm right about 40% of the time, and I make plenty of money, So when you're right, you have to be right in greater magnitude than when you're wrong, et cetera. That's where the risk controls come in. But I guess I'm just thinking of your position as a guy who is writing to people, who know less than him. Let's face it, they want to learn from you. It's got to be difficult to get the message across that, you're paying me to teach you how to be disciplined. You're not paying me for magic secret sauce that's always right in my predictions. That has to be tough.
Yeah, so I write sometimes, do you want to make money or do you want to trade? And there's a difference. There's a difference because some people just want the action. And I say, if you want the action, go to a casino, go to Atlantic City, go to Vegas, have at it. If you want to make money and you want to trade, you want to be a successful trader, you have to understand that discipline. It's not always about the action. Sometimes the best thing is to do nothing, right? Sit on your hands, and I mentioned earlier in the podcast, I kind of reduced some risk, heading into the inflation numbers, heading into the Federal Reserve. Okay, I'm just going to, I want to see what happens. And I mentioned this over the last 2 weeks. Look, if price and time tell me that I need to flip, I won't just get out of my long positions. I will go max short, okay? Because that's what the market is telling me to do. The market is a living, breathing organism that changes with human nature. It's the same thing. It's humans interacting, and the more you see it in the market. So if the market's telling me, look, things are really changing, I'm not going to fight it. I'm going to go with it. And I always talk about the why, or why I don't care about the why, which is, the wall of worry, all the things that we talked about, inflation, all that stuff. Okay. I care about what and when. When is something going to happen and what it's going to do? It's really that simple. So yeah, I mean, it's tough, but I've received great feedback from subscribers for the most part in terms of explaining that over the last few years, and not just explaining it, but putting real money on the line and making money through the COVID crash, the bull market in 2021, the bear market last year, and then so far this year. So I'm doing it in real time.
You're doing it in
not just writing a book.
I see. Yeah. I was going to say, as opposed to what? As opposed to just talking about it and writing a book. And I've talked to some of those folks too. There's a whole industry of writing about trading without actually doing it, which I find a little strange.
Agreed.
Yeah, I mean, we have, of course, we do have rules at Stansberry that say you can't buy the stuff that you recommend in your newsletter, but you can always get close, can't you?
Well, I don't trade any options personally, so I don't. I have a strict rule with that, so I don't trade options for myself, for my family, for anyone.
Really?
Only for subscribers. Nope, I don't trade any options.
I see. Are you just?
I'll trade the futures market, which is, in some respects, even has more leverage than options.
Sure does. Yeah.
But I don't. But I don't trade any options.
I see. And let's face it. A futures newsletter wouldn't really cut it. I mean, that would be crazy.
We've had this conversation before, Dan, and I don't. Maybe there are some people out there in the newsletter environment who can do futures, but I traded futures when I was on Wall Street, and you just cannot, in my opinion, you can't write and send out futures recommendation trades because things can change in 30 seconds, and you can lose $10,000 in 30 seconds. And most people have careers. They're working. The options thing. Okay, it's one, maybe two times a day or a week rather. Okay, that's good. But if I was going to trade futures in the newsletter industry, I'd be trading 50 times a day. Not everybody has the capacity to do that. So to me, it's not worthwhile. Yeah. Are there some people out there who would be willing to do it? I get it. Yeah. But it's not the majority of people. So in my estimation, in my opinion, it's just not worth doing it.
All right. I like to talk about what not to do a lot, because I think all the things to avoid in life are at least as important, if not more important, than the things you should do.
However, here's something else. People want to talk, like, how do I learn how to trade? Okay. If you really want to learn how to trade, if you really want to understand failure, success, and then discipline, most importantly, take $25,000 or $50,000, whatever. Open up a futures account and trade crude oil for 6 months, one lot, every day, buy and sell, and then let me know how you do. You're going to find out really quick about failure, success, and most importantly, risk management, right? But don't hold me if you lose all your money. I'm just telling you, if you really want to learn how to trade, just figure that out.
There you go. Good advice. That'll teach you. That'll show you.
I mean it as a good thing. I don't, I mean it as a bad thing.
No, I got it.
You really want to learn how to trade? This is what you need to do.
Understood. All right. Time for the final question, Greg. It's the same question for every guest, no matter what the topic, even if it's a non-financial topic. Same question. And the question is very simple. If you could leave our listener with a single thought today, what would it be?
Oh, man. So we've had this a couple of times. I think last time I talked about risk management. And then before that, I said, what's your number? Meaning, if you have $100,000 in the stock market and the stock market drops 30%, just get out. And, what's your number that you'll be most comfortable with? So those two things. But as a new one, what will I leave subscribers with right now? Really simple. Follow the trend. We talked about it all podcasts. Follow the trend. Stay disciplined.
Follow the trend. Stay disciplined. It sounds so simple, doesn't it? But it's not easy.
So who? I think it was Richard Dennis, actually. He goes, I'll give you the turtle trader. I will give you all the rules. I will tell you exactly how to be successful, and people still won't do it.
Yep.
It's human nature.
Yeah.
So it is that simple. Stay with the trend. Stay disciplined.
All right. Hey, Greg, it's always great to talk to you, man. Thanks for being here. I appreciate it.
Likewise, my friend.
The Fed wants you to believe they've got inflation under control, but I believe we've only seen the beginning of a devastating new crisis. And if you don't prepare now, you could see your savings evaporate as inflation and interest rates soar even higher over the next 2 years. It all traces back to a golden thread that ties together the biggest financial calamities in America's history. But it seems the entire financial world is falling into this very same denial trap that led to massive devastation the last time this crisis played out. If you know your history, you know there will be winners and losers, and now is when you decide which one you'll be. I've spelled it all out in an urgent new report. Go to www.bankrun2023.com to get your free copy. I'll also show you how to get my complete playbook for navigating this crisis, including the 3 critical steps to take immediately. Again, that's www.bankrun2023.com for your free copy of my new report. So Greg and I are good friends. We've known each other for years, and I still, every time I speak with him, including this time, I always learn something. Even if it's just a reminder, I always learn something about trading. I never heard him say that thing at the end about if you really want to learn how to trade, take an amount of money you can afford to lose and trade crude oil futures every day for 6 months and tell me how you do. I almost want to do it as an experiment, but you got to have the 6 months to spend doing it, because you don't want to walk away from your computer on that one, I'm going to tell you. So you better have plenty of time. But another great talk with Greg, and I hope you do understand, that his takeaway of stick with the trend, stay disciplined. Like I said, it sounds so simple, and it is simple. It's very simple, but it's really hard. If you're a trader, staying disciplined is everything. It's your religion. It's your North Star. It's your everything. And if you've listened to the podcast for any length of time, you know that that's the message again and again and again and again. Every trader, everybody, we stick to our strategy. We stay disciplined. When the stop tells us to sell, we're out. And in fact, that one thing, when the numbers tell us to exit, get out, that seems like the one single thing that is hardest for most, new traders to understand, but it's the single most important thing. And when Greg was talking about failure and losing money and it's all part of the game, that's really it. It's taking that loss and moving on. And Greg is like the guy to learn it from. So it's always a fun talk with Greg. I hope you enjoyed it as much as I did. That's another interview, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as we did. We do provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody else who might like it, tell them to check it out on their podcast app or at investorhour.com, please. And also, do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @investor_hour. Have a guest you want us to interview? Drop us a note at feedback@investorhour.com or call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my co-host, Corey McLaughlin, until next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.